Have you ever been into investing, or are you interested in investing in some things that may help you attain financial freedom, but you are stuck with all the over pieces of information and unwanted topics on investing? You might need these tips to succeed in the next big step. So why wait? Let's explore the world of stock investments with the help of Warren Buffett. Let's see what Warren Buffett says about a couple of stocks that would help you make huge profits but with little investments. Who hasn't heard of Warren Buffett, one of the world's wealthiest people, always ranking high on the Forbes list of billionaires? His net worth was detailed at $100 billion as of June 2022. Buffett is known as both a shrewd businessman and a gracious philanthropist. He is best comprehended as one of the world's most prosperous investors. This is why it's not astonishing that Warren Buffett's investment approach has reached fictitious proportions. Buffett obeys several vital doctrines and an investment attitude that is widely heeded around the globe. Buffett started his career as an investment sales clerk in the early 1950s, but Buffett created Buffett Associates in 1956. Less than 10 years after, in 1965, he was in the guardianship of Berkshire Hathaway. In June 2006, Buffett declared his plans to contribute his wealth to charity. Then, in 2010, Buffett and Bill Gates revealed that they started the Giving Pledge Crusade to inspire other wealthy individuals to follow philanthropy. Buffett heeds the Benjamin Graham School of Value Investing. Value investors look for stocks with unjustifiably low prices based on their inherent worth. There isn't a universally acknowledged way to define innate worth, but it is most often gauged by analyzing a company's fundamentals. Like deal hunters, the value investor trolls for stocks considered to be underrated by the market, but not identified by the plurality of other buyers. Buffett takes this value investing strategy to another level. Many value investors do not sustain the efficient market hypotheses. This thesis implies that stocks always trade at their fair value, making it more challenging for investors to buy undervalued stocks or sell them at excess prices. They delegate that the market will ultimately favor those great stocks that were, for a time, underrated. Buffett isn't concerned with the supply and demand sophistications of the stock market. In fact, he's not frankly involved with the activities of the stock market at all. This is the sense in his famous rehash of a Benjamin Graham excerpt. In the quick run, the market is a voting machine, but in the extended run, it is a weighing machine. He glances at each business, so he picks stocks exclusively based on their overall prospect as an enterprise. Keeping these stocks as a long-term play, Buffett does not seek capital gain but privilege in quality firms, particularly adept for forging earnings. When Buffett invests in a business, he isn't concerned in whether the market will ultimately realize its worth. He is involved with how all that business can earn money. Warren Buffett sees low-priced value by asking himself some queries when he estimates the association between a stock's level of greatness and its price. So if you desire to invest like Warren Buffett, you don't require to do anything unusual. In fact, many recent investors are surprised at the uncomplicated acquisition style of the Oracle of Omaha. Buffett invests in amazing businesses selling for less than their intrinsic value, and then he bears the investments for as long as they stay great businesses. Apparently, there's more to the tale than that. Buffett illustrates that the secret source of his investing triumph is investing in corporations with long-lasting, fortunate economic aspects and trustworthy managers. This strategy is known as value investing, where the objective is to hang on to the top-performing stock instead of trade stocks based on short-term price fluxes, otherwise known as active investing. Aside from knowing how a firm operates and what it delivers to clients, you should also know where the firm will be in 10 years, if not decades, stated Buffett. If you aren't ready to own a stock for 10 years, don't even think about holding it for 10 minutes, he documented to his stakeholders. Berkshire Hathaway famously skipped out on tech outfits Google and Amazon in the early 2000s because Buffett was not certain he comprehended the company's long-term profitability. This made it more challenging to decide the value of their stocks. Buffett had said that the most significant facet in picking a successful business investment is the establishment's competitive benefit, which he compares to trench wrapping an economic castle. The more confident the competitive advantage is, the more potential the company will thrive over decades. Buffett has stated he looks for these three fortes in a manager or leader: brilliance, endeavor, and integrity. But virtue matters the most, because if you're going to get someone without integrity, you want them sluggish and idiotic, he added. As a passive investor, Buffett desires out companies that appear to be bartering for less than their inherent value. While there is no ubiquitous measure of value, firms with long-lasting earning prospects tend to have invariant earnings, good cash flow, and a proletarian quantity of debt. When a stock price seems lower compared to the firm's value, that is an option to buy. But that doesn't imply Buffett seeks out the best deals based on the stock price alone. Simply getting a fair price on a business's stock can be an effectual strategy too. You're investing in the company long term, not just the stock price at the acquisition time. A cornerstone of Buffett's investment ideology is prioritizing a margin of safety. In easy terms, a margin of safety directs to aspects of investment that help to safeguard investors from losing money. For instance, if stock trades off for $10 per share, but the firm's acquisitions are realistically worth $12 per share, then there's a $2 margin of safeness. The inherent value of the assets should stem the business's stock price from dropping too seriously. Buffett consistently strives to pay smaller than a business's inherent value. As he states, a too high acquisition price for a stock of an incredible company can undo the results of a following decade of favorable business growth. Warren Buffett does not invest in the rubble. You normally won't see him purchasing floundering businesses, regardless of how inexpensive they become. One of the soundest Buffett quotes new investors can soak up is, "It's far sounder to buy a great company at a fair price than a fair firm at a great price." Here's another piece of Buffett advice that is especially critical for beginner investors, especially in the current age. Don't purchase certain stocks simply because everyone else is. But again, do not desire to always be a contrarian and vend the stocks everyone else is purchasing. As Buffett does, the finest way to invest is to bypass the crowd completely and concentrating on finding worth on your own. He also states the most essential quality for an investor is a character, not brilliance. You need a character that neither emanates great satisfaction from being with nor against the masses. The apparent goal of stock investing is to purchase low and sell high, but human personality can force us to do the contrary. When we see our mates earning money, we should try to earn too. And when the stock markets crash, it's true to life to get out before prices fall. Buffett loves it when stock prices fall since it creates possibilities to purchase at a discount, which explains why 2022 has been a remarkably active year. If you were shopping at your favorite store and suddenly knew that the entire store's prices were 20% lower, would you panic and dash away? Of course not. Buffett welcomes discounts on his favorite stocks and says chances come rarely. When it showers gold, put out the pail, not the thimble. Favored Warren Buffett quote from when he was requested about an investment he chose to sell at a loss. The most paramount thing to do if you see yourself in a dilemma is to stop trolling. While he really wants to own every stock he buys eternal, the reality is the view changes. It might amaze you to learn that Buffett bought a considerable position in the mortgage agency Freddie Mac a couple of decades ago. But a few years ago, before the financial crisis of 2007 to 2009, he saw that the lender's management had begun to take excessive risks with the firm's capital and chose to sell. When the financial crisis hit, it evolved clear that Buffett had made a clever move. Warren Buffett is the best example of the influence of long-term compounding. Buffett uses dividend reinvestment, compound interest, and the power of continuously reinvesting the operating cash flow induced by Berkshire's businesses to his advantage. How powerful is this? Berkshire has an average of 20.1% annualized revenue since Buffett took over in 1964, likened to a 10.5% for the S&P 500. This may not sound too astonishing until you discover that, over time, this has resulted in a 3,641,613% total earnings for shareholders versus just 30,209% for the S&P 500. So, what's next? Are you going to be among the wealthiest investors by heeding the ideology of Warren Buffett? Or are you just going to lie down and just dream big? Comment down what are your concerns while finding the best stock for investing, and how do you succeed in being a good investor. Until next time, goodbye.